This is the Business Stuff Podcast. This is where I will share the lessons I've learned from advising thousands of businesses over almost 30 years. Each episode will give you practical insight to allow you to learn from other people's mistakes. I'll be pulling in experts from our team and the world of business, and together we'll make sure your business is giving you what you want. My name is Martin, and this is the Business Stuff Podcast. Hi everyone, it's Marty from the Accelerator team, and I'm here with Neil Cowie. Hi Neil, how are you doing?
I'm great, Martin. Nice to see you again.
Yeah, good. Neil is one of our financial planners in Robson Laidler Wealth, and we're speaking to you today because it's Pension Awareness Week, Neil.
It is. It might sound like a really dull thing, which is not a great way to sell it, but ultimately it's good to make people more aware of the things that they've got to do or things they might need to consider for planning in the future.
Yeah. I think people generally will normally do the thing that's in front of them, often the urgent but non-important. So I suppose the theme for today is the really important but not urgent. Yeah. Is often overlooked, isn't it?
That's a good way of putting it. I mean, a lot of what we do is maybe a bit, as I say, a bit boring, a bit old-fashioned, things like budgeting and thinking about the future. But as you say, it is very important because without doing that kind of planning and that, giving it some thought and more importantly some action,
do it for you.
Absolutely not.
So can you just give us 30 seconds about what you do?
Sure.
Because you've been on before, but just for anyone who...
Sure.
Why have we asked you to be here today?
So as you say, I effectively run Robson Laidler Wealth, our financial planning division. Ultimately, what we're about is understanding where people are financially, what they're looking to achieve in the future, and basically helping them to get there by using the resources and assets that they've got to do that.
So it's Pension Awareness Week. We'll speak as if people have no idea about pensions.
Yeah.
We're not aiming this at people who've already, it's about people who don't know anything. So that's the level we're going for. I mean, is it worth just saying, what's a pension?
Yeah, I mean, in its simplest form, a pension is really just a long-term, tax-efficient way of saving money to provide you income in retirement. When you stop working, when your salary stops, your wages stop, it's something to replace that in later life.
And we're talking specifically about, I don't know if the term is regulated pensions, but a lot of people go, that's my pension. And they could be talking about their stamp collection. We're talking about pensions proper rather than just savings pot for retirement.
Yeah, I mean, pension is, as you say, a regulated product, regulated by the Financial Conduct Authority. So we as advisors obviously have to follow rules and procedures when it comes to recommending that type of product. But ultimately, to provide income in retirement, it's about using all your resources. So although we're talking about pensions, particularly this week, it could be the stamp collection if you can turn it into income at some point in the future. It could be your ISA, it could be your bank account, it could be an inheritance, it could be selling your business. All these things could add to your pot in retirement.
And actually that's perhaps accidentally a good way of saying this is why you need to put some thought in. Because if you've got the family trust fund that's going to give you 30 million quid when you're 40, you might not want a pension.
Job's done.
If you haven't got that, like most people, and you haven't inherited your great-granddad's old antique stamp collector, then you need to think about all the things you've got and what place the formal pension has.
Yeah, most people are not, as you say, are going to get that.
You've got to look after themselves.
Significant inheritance. You've got to take responsibility yourself for planning for your own future. Yeah. Obviously, if these things come along, then it can be added to the mix. But
that's where we sound like boring dads, isn't it?
Absolutely.
Look after yourself, so no one is going to do it for you.
Absolutely.
Neil, who generally has pensions and who doesn't have pensions? Because a lot of employed people now are auto-enrolled into a pension.
Sure.
Should we start there with what most people will know as their only interaction?
Yeah, so if you're employed, as you quite rightly say, your employer is obliged to offer you access to the workplace pension. You can choose to opt in, and if you do, then you pay some contributions, or your employer pays some contributions. It's really a great way of getting free money. You're getting your employer contribution without you've got to make your own
Because you
contribution to get
contribute
it.
a few percent, and the
Correct.
employer will have to
Yeah,
at least match.
There's minimums and what have you. And actually, there was a report out just the other week about whether those minimums are sufficient, and actually they're probably not, to be realistic.
It'll get you started though.
It'll get you started. It's a good thing. Yeah. So that covers employed people. Obviously, here at Robson Laidler, we deal with a lot of business owners who might have their own company. That they're not. It's not mandatory that they do their own pension because they're not really covered by those workplace pension regulations.
Because that's there for workers, really, isn't it?
It's employees rather than business owners, particularly. And a lot of business owners say, "My business is my pension." Well, that's all very well if you kind of know how much you're going to sell your business for and when.
And you know you're definitely going to still have it when you get there.
Absolutely.
Because of course businesses fail.
Of course they do. So it's this, using a pension in that example is just maybe a safety net. So if things don't go quite the way you planned them, at least you've got something else in the background to support you.
So I'm going to say loads of old person things. Don't put all of your eggs in one basket.
Yeah.
Have an option. Have multiple things.
Yeah.
And what I tend to find is more sophisticated business owners will spend a bit of time building a business. As soon as they've got some spare, they will then start going back and catching up.
Yeah.
Which I think brings us on to timing as well then, because first people, your first job as a 19-year-old, whatever you're doing, or whatever age, you might go, why would I give up any money for a pension? What's the point in that?
Sure.
So is it worth talking about timing a little bit?
So there's this thing called the cost of delay that a lot of pension companies might produce on their website. So if you kind of Google pensions and how much I should contribute, there's this thing, cost of delay. So the basic message is the earlier you start saving and the longer you save for, the higher your pension fund is going to be when you need it in retirement. It's the magic of compound interest, basically.
Yeah.
You're getting interest or returns on the money that you invest and the returns that you've achieved from those contributions. So basically the message is start as soon as you can. I appreciate that it's old-fashioned, and the example of the 19-year-old starting work, the last thing on their mind is a pension.
I'm not going to say it till I'm 69 possibly.
Sure.
But the point is, it's had 50 years to grow.
Yeah.
Your second year's got 49 years to grow. That will always be better than waiting until you're 50 and then panicking, thinking, where's my pension?
I mean, there's a few calculators online. I'm sure if you Google, how much will I get in retirement, or how much do I need to save, it will be quickly quite obvious. For every year or 5 years or 10 years you delay, quite significantly, that number that you need increases quite dramatically.
I played with that just for a bit of a laugh, and I think I was probably about 40 at the time. And how much do you want at retirement? How much was your fund worth now? Your pension pot? And I said, 30 grand a year, just to see what the number was. And it was a staggering amount of money I had to put in to get what most people, I know 30 grand is kind of average wage in the Northeast, so I'm not belittling 30 grand. But if you're making 100 grand a year and you say, well, I'll cut down a lot and I'll have 30 grand, you've still got to put a decent amount of money away if you wait till you're 40 or 50.
And that's the danger that, people that have left it and they do that kind of calculation and think the number's too scary, I'm not going to think about it.
Let's not even bother.
But something's better than nothing. So if you can start that, great. And don't forget, as we already touched on, the pension's maybe just one piece of the jigsaw to provide that income. State pension, we haven't touched on.
Stamp collection.
The stamp collection. Never come across anybody with a stamp collection.
Pokemon cards for the younger audience.
Thank you. Yeah.
So it sounds like then if you're an employee and a worker, I suppose it's worth saying it's not every employee. There are exemptions for very small employers.
Yeah.
And
most employers,
part-time employees, and casual workers. But if you work a full-time job for any kind of size employee, then employer, you've probably got a pension.
You've got the option.
The first thing is it's free money. We're not saying you should have a pension, but why would you turn down a gift horse? Because the employer's going to put in.
Yeah.
And they don't have to pay you that money if it doesn't go in the pension. It's just lost, isn't it?
Correct. So if you choose not to opt into the pension, you don't obviously then get the benefit of the employer contribution.
Basically free contribution.
No.
So if we say workers have a starting point, we'll come back to whether that's enough, and we've probably covered that a bit. Is it fair to say then that the self-employed or the people working for their own companies are probably the people who need to think about this more consciously?
Yeah.
Because there isn't an automatic version for them, is there?
The government's obviously tried to essentially what they're trying to do is take the pressure off state finances in 20, 30, 40 years down the line by encouraging people to save. They've started with employees or workplaces. So the self-employed obviously aren't part of that legislation, as you quite rightly say. So there's not the kind of mandatory force or the motivation, if you like, to start a pension.
Yeah.
So it's probably more important for the self-employed to think about it, I would say.
If you're self-employed, a lot of people say they work for themselves. They don't necessarily always think about whether they're self-employed or work through their own company, for instance. There are different types of pensions, though, and different ways to do it.
Yeah, I mean...
do they matter?
Not
Does money
really.
all just end up in a pot?
Yeah, the principle, I mean, essentially there are two types of pension schemes. There's something called, technically it's called defined contribution, which all that means is you simply save monthly or annually and you build up a pot in your own name. That's the most common one in the UK today, type of pension. The other one is something called a defined benefit scheme, sometimes known as a final salary scheme. So you tend to find like the big public sector employers have that, so NHS, teachers,
they're going to get a practically guaranteed amount out the back end.
So it works in a different way where you kind of get a promise of a pension based on your earnings and your length of service. Those are very rare, and certainly very few private employers have that type of scheme. They're very expensive.
Most of the old school, like your BPs, BT, like
large
very large
multinational companies might have done that in the past.
All but gone now.
It's a massive liability really for companies to fund that type of scheme, and therefore most have withdrawn from that type of scheme.
So that gold-plated pension is outside of the public sector, fairly unusual.
I guess most of our podcast audience will be more inclined to look at the defined contribution type of scheme.
And all that means is defined contribution is just you fix the amount you put in.
Yeah. Basically,
fancy, but it's
what you get out at the end is based largely on what you pay in over the years and how much that grows by.
When can you draw a pension? We've talked about starting early, start as soon as you can. The sooner you start, the better. How long are we going to wait?
Sure.
If I'm 19 years out now, it's probably not going to be 68 state pension age when I get there.
Sure.
But what's the rules today?
Okay, so currently the minimum pension age or the age that you've got to be before you can draw from your pension is 55. That is changing. It's going to be linked to the state pension age. So it's the state pension age minus 10 years. So if your state pension age is 67, then clearly you're going to only be able to draw your private pension at 57. Right. And obviously as the state pension age goes up, as it looks like it will be over time, that minimum pension age will go up in the same way.
It's important to state here that your private pension and your state pension aren't otherwise linked.
Not at all.
You can have one and not the other, and we're talking about the private side, the thing you provide for yourself here.
Yeah. So everybody that's paid national insurance contributions will be building up credit towards the state pension. The maximum state pension at the moment is something like 10 grand a year, which is decent core income. It's nice and inflation proof, so it's obviously guaranteed because it's paid by the government. But you've got to have at least a minimum of 35 years of contribution history to get that maximum.
We might come back to it, but there are ways to check whether you're going to get your full state pension as well. Actually, should we just cover that now?
Yeah, sure. I mean, part of our sort of financial planning advice and guidance that we give to people is to maybe periodically check what your contribution history is for state pension and what you're kind of projected to get as a state pension. And if there's any shortfall, you can voluntarily add contributions if you wanted to get yourself up to that maximum.
So if you're checking you're on 25 and you think, well, I need another, is it 10 years?
10 years, yeah, 35.
You can weigh up whether it's worth buying those additional years.
Not normally, if you're in good health and you feel like you're likely to live for a decent length of time in retirement, it usually makes sense to make those extra contributions because the return you get on them is usually pretty decent.
Yeah. You've mentioned assuming you're planning on getting your pension there, which was one of my questions. So some people might say, putting your pension, you've got to wait till you're 68, what about 57, 58, 59, whatever it is. You go, yeah, but what if I don't get there?
Yeah.
What happens to your pot then?
Sure. Pensions are actually good in a number of levels, and the death benefits, a bit morbid to talk about, but the death benefits are usually pretty attractive. So as things stand at the moment,
you don't go in for the death benefits.
No,
that's the silver lining.
Unfortunately, the criteria is you've got to die to pass it on. So yeah, the pension's in your name, but if you die before you're able to take it for yourself, or even after you've taken it for yourself, whatever's left in the pot is usually available to your dependents, whether it's your spouse or your children or wider family members. So at the moment, that is generally tax-free. That value is tax-free to beneficiaries if you die before age 75. If you die after age 75, potentially that payment could be taxed in the hands of the beneficiary. But we're getting overly technical there.
We've got to get something in there first, haven't
Correct.
we? What do we need to think about, Neil, when a lot of people will have heard of widows' pensions?
Yeah.
At what point do we need to think about that? Because you might say, well, I'm not married yet. Mm-hmm. This mythical 19-year-old Pokemon collector isn't even married. They can make that decision at the back end, can't they? Get it in there now, and you can change down the line if you need to.
Your main priority while you're working is to try and take some surplus income, save it over a long period of time, and build up that pot. And you're quite right. As you get to that point where you're stopping working and you're then relying on that pot, you've got a number of choices that you've got in how you take income from that pot. The modern way is probably something called income drawdown, where you simply leave the money invested and draw down a monthly or
just what you need,
annual salary from that pot. The alternative, which is maybe more traditional, is you buy something called an annuity, which is a guaranteed income for the rest of your life. Annuities are generally based on interest rates, so the higher the interest rate is, the more income you get with the same capital sum. So it depends on the client's circumstances.
And of course, anyone with more than a couple of years to go doesn't need to worry about this just yet.
No.
But the closer you get to it, the more you should probably think about it. It's too late to kind of go on retiring next week.
Sure.
You probably need to, when should you think about this? How far in advance of retirement?
So, there are you could go online to sort of do some calculations on, this is the size of my pension pot, this is how much I'm contributing, this is when I plan to retire, what sort of income will that give me? I mean, as a general rule of thumb, you might use something like 4 or 5% of the pension fund value as a realistic, sustainable income from that. So if you've got 100,000, for instance, 4%, that's £4,000 a year. So hopefully you can, by that calculation,
£20,000 a year, you
exactly, I was
need
just going to say that.
quid.
Yeah, so you need quite a large capital sum to provide you anything comparable to your
because that's like 25 times, isn't it? 4%. Correct. You need 25 times the annual amount you want.
Another way of looking at it.
Yeah,
definitely.
So that's why you need to get that done over as many working years as possible, rather than just.
It's the same message. The sooner you start and the more you put into it, the more you're going to get out of the other end.
You mentioned drawdown, Neil, and you said, you mentioned that's a more modern way, perhaps. What's the main advantage there then? Is it just that you can leave more in your pot for someone else to possibly inherit, or
that's certainly one of the advantages,
or just flexibility, or what's
so both of those things. Up until the last maybe 12 months, annuity rates have been very low. Interest rates have obviously been very low until recently, and therefore annuity rates have been very low, which means that you need more capital to get the same income.
So that 25 times ratio would have been a greater ratio with lower interest rates.
Yeah, absolutely, a higher number and higher multiple to get to the same income. So annuity rates haven't been particularly attractive. So drawdown, where, as I said, you simply leave the money invested and take out what you need or want every year to spend, has been more attractive. Flexibility, you're not locking into a very low rate. That's kind of changed a little bit with interest rates going up, and maybe the decision's slightly different for certain clients. Risk comes into it as well, so people that are prepared to take some investment risk.
Because if you leave it in there, it's still at risk.
It's at the vagaries of the market.
Is all but guaranteed.
Pretty much fixed and guaranteed. There are various options, but generally they're guaranteed, yeah.
So the drawdown might be particularly advantageous if, for instance, you want a bit of extra income, but you're still working, or you might still work, or because if you've got another source of income, why would you draw down on the pension and lose that possible investment return? Yeah. So again, it just gives you the choice.
So it's generally, as you quite rightly said, flexibility. You don't have to just draw a monthly income. You can take ad hoc sums out of the pension pot when you need them, maybe to combat low interest or annuity rates. And you mentioned the death benefits as well. If you buy an annuity, your capital's gone. You can build in a provision to provide a spouse's pension. So typically it's 50%. So if you get, I don't know, £10,000 a year and you die, then your surviving spouse gets £5,000 a year for the rest of their life. But with the drawdown arrangement, whatever the pot value is, that's available to your dependents, which might in some ways be more attractive.
What's the... There's a couple of things that I kind of want to get onto, and I wrote Ferrari there because there was this. I can't remember when it was now, but do you know where I'm going with this?
I do, yeah.
I suppose what I'll mention about Ferrari is that there was this idea that, was it A-Day? Was it 2016?
I think it was around then, yeah.
They kind of said, oh, well, if you've got another source of income, you can just take all of your money out of your pot. And there was a panic that pensioners were going to be buying Ferraris and Lamborghinis. Yeah. But I don't know if that necessarily happened, and probably the market settled a bit and those concerns are gone. But you do still see a lot of people who've tried to do something clever and kind of lose their pension pot. There's a lot of people out there going, I can give you all your money and you're buying someone else a Ferrari. And you don't, like, how do people make sure they're getting good advice from someone who isn't going to just buy their own Ferrari on your pension? Yeah,
well, again, this is a slight punt of our services, but clearly using a trusted advisor, they can help you make those sort of decisions about how much you withdraw, when you withdraw, how sustainable that withdrawal is, whether you're going to run out of money or not. And clearly the problem is that if you have this pension pot, which might be your biggest asset, even including your house, depending on how much you've contributed. And it's very tempting to say, I've got, 200, 300, 400,000 in the pot. It's all mine. I'll take it on day one of retirement. Well, you can do that, but will it last you?
What are you going to do with it?
Absolutely. And how much tax are you going to pay in getting access to it? And
how do people know if someone's trusted them, Neil? And obviously you'll say, well, a reputable firm being around for a long time.
Sure.
But it is a regulated market.
Correct.
People need to have certain things to be able to give pension advice, don't they?
Sure. So obviously you need to be authorised and regulated by the Financial Conduct Authority. So you can check out the firm by doing a quick check of what's called the FCA, Financial Conduct Authority Register. That usually lists complaints as well.
Is it as simple as you should never get pension advice off anyone who isn't on that list?
I would say so, yeah. I would definitely say so.
Because
nobody in the UK can advise you on a pension legally unless they're regulated to do so.
So if they're trying to, they're probably, they're either not expert or they're up to no good.
I would say so. That's a good way to think
about it. That's not necessarily a plug for Robson Laidler Wealth. There are lots of FCA regulated.
Absolutely.
It's not like there's 3 on a list we've made up. It's the standard, isn't it?
And like any product or service, a lot, or in fact probably most of our clients come from personal recommendations from existing clients. And if you go to a nice restaurant, you tell your friends about it and they'll tend to go to that restaurant too. It's the same for advice or taxation advice or whatever. If you've had a good service from an existing advisor, that's a good recommendation.
The next thing I wrote then really, Neil, is people might have a lot of spare income and can easily afford a huge pension contribution, but it's not necessarily that they should just put all available money in a pension. What kind of tools are there available to help people, or what do you do to say, oh well, to give you that 30 grand a year, you need to put a grand a month away, but do you really need 30 grand a year? Like how do you plan that?
Sure. So we very much major in something called financial planning. So again, we use that expression slightly boring perhaps, but it's a way of mapping out your future in terms of income and spending. So the starting point really is, how much do you need? What do you spend your money on now? You're likely to spend your money on similar things in the future. Some expenses will drop away, maybe like things like childcare, mortgage costs. The older you get, the less likely you are to spend on those things, but they might be replaced with other things like more time for holidays, leisure, all that stuff. So we kind of try and assess what people spend. And then we work out, okay, what resources have you got? Maybe pensions, as I say, bank savings, ISAs, downsizing your property, your business, inheritance, different sources.
How many weddings are you going to pay for?
All that stuff. And as a father of 2 daughters, that's certainly on my financial plan. So it's basically just the financial planner's job is to understand all of the available resources and come up with a plan of action. Because a bit like investment diversification, it's useful to have, if you like, we'll call it product diversification. So it's good to have some money in pensions, and I would always advocate them. Excellent long-term tax efficient products. Yeah. But if you've got other tax allowances from other types of investment products, you can spread that tax cost more effectively by using different types of products. And that, again, that's a financial advisor's job to help you with that.
Because one thing we haven't touched on is normally once money's in a pension, you can't really get it out, can you?
No, you can't.
So if, just because you can put $5,000 a month away or $1,000 away, doesn't mean you should. You might balance it with something slightly more flexible.
Accessible. I mean, it's a blessing and a curse to be able not to access your pension. Yeah. It means you're disciplined. It's in there. You can't squander it.
You can't.
But the downside is you can't access it perhaps when you need it.
And that's one of the reasons, I presume, why people go, if I put it in, I can't get it.
Sure.
Yeah, blessing and a curse, like
you said. Our general advice when we're talking to clients that have got maybe some surplus and they ask, well, what should I do with the surplus? We usually do a bit of both. So maybe the 2 main products we use are pensions and ISAs. They're the very tax efficient investment products that we can look at, both regulated by the Financial Conduct Authority. We tend to recommend you do a bit into both of those for different reasons. ISA's a bit more short term, a bit more accessible. Pensions a bit more long term for future.
One thing that always struck me as amazing, and I always swore I would do it when I had kids, and I didn't do it. Sorry, boys. Is the fact that you can pay into pensions for other people.
You can,
including your children and grandchildren.
You can, yeah.
So if we're talking about someone who's got everything, all the boxes are ticked, and they're completely fine, but still have spare capital, is it worth just touching on? Yeah, a nice thing for a grandparent to do for a grandkid, for instance, wouldn't it?
I know when that kind of legislation came out initially, where I worked at the time, we did quite a bit of that kind of planning, where typically it was a grandparent was saving for their grandchild. In some ways, it's a very good kind of estate planning sort of mechanism, a way to reduce potential inheritance tax
on the person making the payments.
Yeah. So you're putting it in. It also ticks the box, you're giving little Johnny £100 a month into his pension, but he can't touch it until he's, probably in his 60s.
Little Johnny can't waste it when he turns 18.
Eons away. To some extent, that kind of planning's probably, for most people, been replaced with things like junior ISAs, lifetime ISAs, that sort of thing, where a parent or a grandparent
you still get the markup. But they've got to be another clearly defined way to get it.
Yeah. So that might replace.
But the advantage on the pension is if you put in when someone's just been born, that's now got 68 years to grow, or whatever. So they've got 18 more years to grow, which again can really get that compound kind of growth going.
Yeah, I mean it's a
I'm not advocating. I'm just saying,
sure.
If you've got nothing else to do with your money, you might consider it.
Again, these are the sort of things that a planner would work with you to say, have you looked after yourself first? Have you done all the sensible things you should do personally? You can then maybe start thinking about some estate planning and gifting money to your family. What vehicles do you use to do that? What's the objective of that money, and what's most appropriate to do that with?
We've touched earlier on public sector pension or the kind of the final salary pension. Yeah. Does that mean they don't need to do anything, or are there still planning options with their pots? Yeah,
so again, if you're in a public sector or defined benefit pension scheme, usually you'll have a fixed rate of contribution. Most schemes, I guess, will allow you to pay more than the fixed rate, and if you do that, then obviously you're just buying yourself some extra pension when you come to retire.
So is that if someone starts a job and when they're 40 and they get to 60 and think, I wish I'd been here since I was 30, they can backfill those early years?
Yeah, to some, I mean, there are limits and legislation around that, but ultimately it's the same principle, should I contribute more to get a higher pension to make up a shortfall in retirement? So it's the same idea.
Do they have flexibility on the way out as well, or
less so? No. So again, the minimum pension age applies to a defined benefit scheme. usually, because of the way these things are worked out from a kind of mathematical, actuarial kind of point of view, there's usually a charge for taking your benefits earlier than you were planning to. So if the scheme normal pension age is, say, 60, and you decide I'm going to retire at 55 and I want to start my pension, instead of getting your 10 grand, 15, 20 grand a year, you get 10%, 20%, 30% less than that because you've taken it 5 years earlier.
So you really need, again, if you're doing anything other than a standard, you need to get some good advice again.
Yeah, you need to understand.
Don't just assume the workplace HR has got your back.
No, not at all.
They might not have your back.
Again, the kind of recurring message is you've got to take responsibility for yourself and work out what you need personally and what you're going to get personally to work out that.
Neil would normally finish by saying, what's the one thing people keep getting wrong on your specialist topic, but we'll do pensions today. What's the thing that people keep missing, keep getting wrong, or just totally misunderstand about?
There's probably more than one. I was thinking that maybe the three key priorities I would argue that you should really think about is, as I've said already, start as soon as you can, probably pay more than you initially think you should pay, because that will benefit. And it's about the investment of that money. Most people tend to go for cautious or moderate risk. That's usually a bad idea, particularly if you've got 40 years ahead of you of saving into a pension. You should really go for, again, without getting too technical, a fund that's got a high proportion invested in the great companies of the world, equities. That's going to provide the biggest return and therefore mean that your pot is worth more than it could be if you went more cautious. Because
actually all we've talked about at the moment really is the contribution. It's worth saying that for business owners, that there might be more, people will talk about SASs, SIPs, there's a whole range of different things.
Some business planning angles to pensions for business owners.
You can build a pot up to buy commercial property if you want to do that. Yeah. That's more of an investment, a
bit more specialist.
The rules on the way in, the tax relief, the tax growth, they're all fairly similar. Yeah. But there are a whole other world. Not for Pension Awareness Week though.
No, maybe not.
We might have you back on a separate time. It's all about SIPs and SASs and stuff like that.
But yeah, just an important point. As in the same way, there's a big difference over long periods of time for contributing an extra 1% of your salary or whatever to your pension. It's the same true from the investment point of view. If you can generate an extra 1% a year return, that makes a massive difference in 40 years' time.
Yeah, I mean, an extra 1% on 100 quid across 50 years will nearly double it, won't it? If not more than double.
Probably much more than double. I don't have the number to hand, but certainly there'll be a big gap.
Good. All right. Thank you very much, Neil. That's been great.
Thank you, Martin.
We hope that's answered some of the typical questions you might have in Pension Awareness Week. Neil and the team will always be happy to hear from you. Reach out. Contact details are down below. If you've got any questions, let us know in the comments. Well, meanwhile, please be sure to subscribe and follow the channel.